Alright guys, stick with me to the end of this video and I'll show you two of the best mid-cap stocks to buy right now. Fluence, ticker FLNC, is a leading battery provider with, in my opinion, 5x potential from here. The demand for power is exploding, mainly due to the rapid data center build out. And most of the new capacity should be coming from renewable energies like wind, but storing this energy is going to be critical, and that's where Fluence comes in. So, what's driving the need for battery storage? Isn't renewable energy good enough? Well, actually, no. At the rate we're projected to be using power, citing Bloomberg, they expect the data center power demand will quadruple in the next 10 years. AI is driving the rapid data center build out across the world. Where's all of this supply going to come from? Renewable energies won't be able to cover all of it. So just to show you with the graph here, most of the supply will come from renewables. Fossil fuels will largely be depleted over the next 50 years or so. Renewables and nuclear are the only options. Bloomberg expects 70% of the power will come from renewables in 2050. However, renewables come with challenges. One of the critical challenges is storage. Solar and wind are dependent on weather conditions, and nature decides that, not us. We don't have a say in that. In my opinion, when possible, all the energy should be generated and then stored for later use. We're going to run out, or certainly come close to running out of energy, and need a savings account, so to say, of energy. And here's where FLNC comes into play. I mean, Fluence is one of the leaders here in utility scale storage solutions. It is three integrated business services here: storage solutions, long term maintenance services, and software for energy trade and monitoring. This integrated stack differentiates it from competitors and makes it a preferred partner for energy solutions. So what have the results been so far? Business is booming. It grows revenue by 34% annually in the last 5 years, which has been driven by strong demand for energy storage. It also finally hit that inflection point and became profitable last year. Bloomberg expects that renewable capacity will nearly triple in the next 5 years. This will drive demand for energy storage, meaning even if Fluence grows at the same rate as the renewable capacity, the company can easily achieve 15% annual growth rate until 2030. I will point out that on a EBITDA basis, the company did turn a profit for the first time, but in my eyes, the better metric to apply is a free cash flow metric. And looking at the cash flow statement, you can see everything's red. Cash flow from operations, what we really care about, is negative, which obviously is concerning, meaning they'll either have to inject equity and dilute shareholders, or they'll have to, take on debt. I have forward-looking multiples to my side here, and since they are barely profitable, the company has sky-high PE and EBITDA ratios, as you can see. But the revenue multiple, in my opinion, is more appropriate to use, and it trades below 1 times, which makes it a good risk-reward play, in my opinion, for right now. All right, next up on the list here is Pagaya Technologies. It was created because consumers struggle with getting credit. Ticker PGY is essentially a fintech company that connects consumers with investors for personal and auto loans. They've partnered with some big names like SoFi and Ally Bank and have more than 31 partners in 3 markets. Pagaya has been able to utilize artificial intelligence to approve applications in less than 1 second and has evaluated nearly $3 trillion of funding. The amount of data they collect is massive, which is valuable in its own aspect, but also valuable in training their software to assess loan risk better and spot trends the human eye wouldn't always catch. So I just wanted to run you through a quick example of what getting a loan from Pagaya looks like. Jane Doe is not approved by a traditional lender, let's say Wells Fargo Bank. Then Jane's application gets sent to Pagaya. Pagaya evaluates application and sends a recommendation in under 1 second, and Jane receives the loan. The outcome is basically a very seamless, digital, quick experience, and the lender gets to maintain the customer in the relationship. The borrower gets the funds, and Pagaya works behind the scenes to make this all happen. We touched on this earlier slightly, but Pagaya has a constantly expanding data mode. They have billions of data points of payments, geographies, household income, late payments, delinquencies, age, and just so much more. Having this amount of data is going to become increasingly more important and valuable as AI becomes more prevalent. So I thought this was interesting because it talks about some of their partnerships, but more important, it kind of gives you an idea for where they're heading in the future with being in conversation with 80% of the top 25 US banks by asset size, and they're looking to add 2 to 4 new partners yearly. A lot of these banks are in late stage discussions at the regional level with Pagaya, and they're getting strong demand for point of sales financing to kind of steal back some of that market share from fintech companies. So I have their income statement here, and if you take a look, basically, revenues have exploded going from 91 million to 1.1 billion here in the LTM over a 5-year period. And their EBITDA just turned the corner here in 2024 and looking to double it in the LTM here. And again, like always, free cash flow is a more fair measure, in my opinion, of profitability. So if we take a look here, net income has been negative, but if you look at actually the cash from the operations when you get rid of everything, they've been positive now on their going into their third year. And from a free cash flow perspective, they've turned the corner in the last 2 years and are at 5% and doubling their margins at 10%, starting to become profitable. And Piguet is really attractively priced right now. When you take a look at their forward-looking valuation metrics, they're trading at 2 times EV to revenue, and they're trading at price to earnings of 10 times. They're trading at a 6.2% free cash flow yield, nice and juicy. I mean, this is a nice stock that has some high growth potential and is really undervalued. All right, so that's it. That's all I have for you guys. I like both Fluence and Pagaya. Let me know in the comments if you would buy and what you think. Hope you learned something. Take care, guys.